All right, there's a few more rolling up now, which is great. So I guess we should start the presentation. What we want to do is finish it within the hour. So the plan will be for Gary to do his presentation for about 30 to 40 minutes, and then we'll open it up to questions. So if you've got questions, there is a little box down the bottom, which if you can see a Q&A, you can enter your question in there. If you want just to let us know that you can hear us, just put in a hi or something like that. That'd be great. And we'll get going. I can get this screen to move. Oh, there we go. Okay, so the agenda is as what we've got listed there. So Gary will be going through a process of giving some insights so that you can share with your students about the borrowing process, and along the way it will also be very helpful for your own purposes. If you've got a loan or looking to take out a loan, you'll be able to tap into that knowledge to make sure that you can get the best rate possible. And then Gary will also outline the grants and subsidies that are available, the current lending environment, whether it's time to review your loan terms, and how a mortgage broker can help, and then he'll provide some tips and takeaways. And then, as I said, we'll get into the questions that you might have along the way. So we'll just give you a little bit of who EduHealth Solutions are. Our motto is we want to help grow happy and healthy schools. So part of what we do is we have an enrolment inquiry management process, which is going really well at the moment, given the current environment where we can't have open days. We can have virtual tours or live virtual tours, and we help manage that process. And also the other thing we like to do is help improve staff wellbeing, and what better way to improve staff wellbeing than to help them be able to reduce the stress of a loan and reduce the costs, and help them save a few dollars along the way. So I'll just now hand over to Gary, and he can give a bit of a insight into what he's about.
Thanks, Damien. So it says there that Smartline's a leading mortgage aggregator. We're in the top 10 aggregators across Australia. So aggregators are, Aussie Home Loans, Mortgage Choice, those sort of companies. So we're certainly right up there amongst those. There's over 300 of us across Australia. We've been around for a long time, over 20 years. We don't generally, as a rule, advertise. We're more of a word of mouth provider. So do a great job for you. You refer me on to someone that you know, and that's how we really look to grow our business. We're all individual franchisees, so we're all small business owners. So my own background, I've got 30 odd years in banking with the CBA. So I was with CBA for 31 years, mainly in a commercial and corporate role, and the last 7 years as a mortgage broker, really specialising in the residential and commercial finance space, residential being a mix of home loans, investment properties, self-managed super fund purchases, those sort of things. So quite a spread across a number of different areas. We have 34 lenders on our panel, so hard to believe there's that many in Australia, but there's that many plus a lot more. From all the lenders you know of, the majors plus the second tier recognised brands, to lenders you might not have ever heard of, lenders that help out clients who have credit default issues, right through to some industry bodies as well. So 34 different lenders across our panel, which gives us a wide choice of lenders that we can deal with, which is great for us. Alrighty, so we'll go on to the next slide.
Slide, Gary.
Thanks, Damien.
There we go.
Yeah, there we are. Good. So I just want to give you a bit of a background on the borrowing process, and I guess what I do when I meet a client for the first time, and this is really important in terms of how we get our clients ready to borrow. So it's taking the time to understand what the client's needs are, A lot of clients have different needs. It might be purchasing a house and land package. It might be buying an established property. It might be consolidating debt, getting cash out for future investments or future opportunities. For me, it's really trying to understand what the client's needs are. So primarily what you're looking for and what are you trying to achieve. So the medium goals, short-term goals, medium goals, where do you want to be in a couple of years? Where do you want to be in 5 years? Is the product we're talking about going to be suitable for you not only now, but into the future as well? So it's a long, lengthy discussion, half an hour or so. What are you trying to achieve? It's not just a case, okay, you need a loan, great, let's go. It's to understand what you're trying to achieve and what your goals are to try and set you up in the right level of, or the path to success, I guess. Then we're looking to gathering information from you, things like pay slips, understanding your financial position, assets and liabilities, commitments, all those sort of things. And then really assessing the suitability that you will have for particular lenders. I was saying to Damien before everyone joined us that amazingly, every lender has a different way of assessing an application. They have a different way of looking at income levels. They have a different way of looking at your commitments. Living expenses are a big focus of banks at the moment. So there's a lot of different things that each bank has, and they all have a little nuance as to how they look at transactions. So understanding everyone's individual situation is critically important when you're working out who the lender's going to be. In terms of the question there, is a credit history important? We've just gone through a phase where we've moved into an open banking regulatory system. And what that means, open banking, is that a lot of banks are signed up to this program, and it means that the banks can see all the information about you directly without you even declaring a lot of it. So they can see if you've got credit cards, they can see if you've been meeting your repayments on your commitments on time, they can see if you've been paying your utility bills and your phone bills on time. And a lot of that comes into your credit history and how important that is. It's critically important to know that you've either got a clear credit history or you have issues in your credit history, because that will certainly determine your success or failure rate with the majority of lenders. Open banking is really, really important now. And we're seeing a few people caught out when they're disclosing their credit history to me, and they're forgetting about things like credit cards and, maybe went into Harvey Norman and purchased some furniture a couple of years ago and got a credit line and forgot that they even had that. And then the bank's going to come back and say, well, hang on, we've looked at your credit report. You've got these debts you haven't disclosed. Why haven't you? It might be something you've forgotten about in the past. So credit history is important. You can't really hide anything nowadays. Back in the good old days, you sort of told the bank what they needed to know. Now they know everything, and it's up to you to verify that information. So it's really important to declare your full position. And in terms of preparation, it's really also critically important if you're sort of planning to borrow in the future. There's a lot of focus at the moment, and has been and will continue to be, on how clients are spending their money in the lead up to borrowing. So if you're sort of 3 to 6 months out from wanting to get a loan, you start reviewing your spending habits and your living habits, because the bank will, and I am required to go through your bank statements line by line to see where you're spending the money. So if you've got a fairly liberal discretionary expenditure in the lead up to applying for loans, that can count against you when you're applying for the loan. So in terms of preparation leading up to borrowing, have a look at your spending habits, modify your spending habits if you can, clear up any personal debts that you may have, personal loans, credit cards, store cards. Zip pay is a big one also that catches people out. Just sort of look to tidy them up in the lead up to wanting to borrow. And that's a really good preparation piece. And then there's the information that you need to provide, which is quite detailed, but mainly revolves around what your commitments are and what your income levels are. So I hope that gives you a bit of an idea and a bit of an insight into the preparation piece. Certainly 3 to 6 months out is a good time. Most lenders will look at your spending history for the last 3 months, but there are a few now who are looking into your spending history in the last 6 months as well. So if you can clear it up during that 6 month lead up, that'd be a good time to do so.
That's a good tip, Gary.
Thank you. It's a big focus, particularly since the Royal Commission as well, where there was a lot of heat on. There's a lot of heat on mortgage brokers. What started out as the Royal Commission to the banks turned into a bit of a deep dive into mortgage broking for some weird reason. But the assessment of living expenses was a big piece of that component that came out of it. So, so to give you an idea what the lender looks for when they're looking at your qualifying ability, I guess they look at your credit score and your ranking, which we just talked about. So if you want to get a credit report, that'll give you a number. So they actually give you a number of what your credit history is, and up to a certain level. So I think it's up to about 500. The bank's going to have probably a differing view on your credit worthiness. And over that 500 mark, it's generally fairly okay, but there's some things you may need to explain. From an income point of view, they're going to be looking at things like what's your employment history. So have you been changing jobs on a frequent basis, or have you been in the same employment for a long term? They look for not just changes of employer, but changes of occupation. So you're moving around through different occupations, or it may be okay to change employers if you've got consistency in an industry or consistency of an occupation. But if you don't have that, they may want some explanation as to why your jobs are changing. Obviously, in this crazy COVID time, they're looking at industries that are COVID affected as well. So if you're in retail or hospitality or travel or something like that at the moment, you're going to find it pretty tough to try and get someone to look at your finance for you. So they're going to look at the stability of the industry that you're in. And then they're also going to look at your equity. So how much deposit have you got available? Do you have enough to contribute towards what you're trying to achieve? There are various ways around contributing less deposit into it. They've got a lender's mortgage insurance scheme, which is basically for anyone borrowing more than 80% of the property value, you pay mortgage insurance to a mortgage insurer who may allow you to borrow more than 80% of the property value. You've got parental guarantees, which some of the banks do offer now. So parents or siblings or a direct family member can put up their house as security to meet any shortfall you may have in your deposit. And then the government's also got a first home loan deposit scheme where they can cover some of your mortgage insurance costs, which I'll talk about a little bit later on as well. So certainly from our point of view at the moment, trying to have a 20% deposit, which is what banks really love, is not always that easy to do given where property prices are. So people may not have that 20% deposit. So there are various options out there if you don't have that. And it's a case of working out again which one's going to be most applicable to people. But the ideal goal to get the best deal and get the lenders loving you, 20% of the purchase price is a deposit. And then you're sort of in a good space to be able to have a really good negotiation with lenders on interest rates and that type of thing. Alrighty, so ins and outs of loans, interest rates. Yeah, interest rates is a really interesting comment at the moment. We haven't seen a lot of movement in interest rates for a little while now. We've seen the RBA stay pretty standard because they don't have too much more room they can move anyway at 0.25%. So there was a while ago where if the RBA moved, the banks would move in sync with them, but that hasn't been the case for quite some time now. Banks will move independent of whatever the RBA wants to do. So from an interest rate point of view, the deals out there at the moment, they're the best interest rates I've ever seen in my time in finance. There's some outstanding opportunities there. Banks will reward clients who put in more equity into their transactions. So if you've got 20% deposit, you'll get a certain rate. If you've got 30 or 40% deposit, the banks will reward you even better than that by having more equity in your property that you're wanting to work with. That's regardless of whether you're purchasing property or even looking to refinance, consolidate debts, or whatever the loan to valuation ratio. So you level a debt against the property value. The better that is, the more negotiation we've got with the banks in terms of what they offer. Banks generally, of course, charge fees. They generally charge on a home loan. They may charge you an annual fee, which is basically a package fee that allows you to package up things like offset accounts, redraw, split fixed and variable interest rates. But generally with a home loan, there's not a lot of fees that are associated with it. Apart from that annual fee, there are lenders out there who are offering deals with no annual fees as well. So you can try and work out what is going to be the best deal for you for what you want to do. Fixed interest rates compared to variable, we're in that unique situation now where fixed interest rates are cheaper than variable rates and considerably cheaper as well. And I guess that's probably an indication that no one thinks interest rates are going to move for the next couple of years. certainly every economist you listen to suggests that there's going to be no interest rate changes for 2 to 3 years. So what we're finding at the moment is that really unique situation where a fixed interest rate will be potentially anything from 0.4 to 0.8% cheaper than the variable rate. So it's a really wide margin at the moment. Probably gone through an interest rate or an environment pre-COVID where clients were sitting on variable rates and the expectation rates would move. Certainly in the last sort of 3 or 4 months, and particularly since COVID's been around, there's been a real change across the fixed interest rates, purely and simply because speculation rates aren't going to move. And why not get an interest rate that's 0.4, 0.5, 0.6% cheaper than what you could be on otherwise in an environment where we don't think rates are going to move anyway. So seeing a big swing across to those fixed rates at the moment, just on the back of those offers that the banks have got out there. An offset account. So basically an offset account is really an account that where you have your money paid into. It's an everyday transaction account. So it's generally like your salary account. You get your wages paid into the offset account. And whilst that money is sitting in that offset account, it's actually offsetting the interest you're paying on your home loan. So if you've got a home loan of $100,000 and you've got $2,000 sitting in your offset account, you're only paying interest on $98,000 of the home loan for the time that money is sitting in your offset account. It's a pretty simplistic explanation of an offset account, but that's how it works. No offset accounts against fixed interest rates, so it's important to note. So it's only offsetting against variable rates in most circumstances. Some lenders have a partial offset on fixed rates. Majority of them don't have any offset against the variable rate loan. And from a loan term point of view, the normal home loan's generally a 30-year term. Most home loans don't run that length. I think the average home loan's about 6 to 8 years at the moment. The things you can do to drop that loan term down are pay more often, so pay weekly or fortnightly repayments, which are always better than paying monthly repayments, paying a bit extra off the principal when you can, either a lump sum or just increasing. If you've got a weekly repayment of $150 and you make $200 instead, that's going to significantly shorten the loan term. But a standard loan term for a home loan is 30 years. On the commercial front, standard loan term, banks are starting to relax their terms at the moment, but generally it was somewhere between 15 and 20 years for a loan term on commercial finance. There are a couple of banks now who are letting commercial loans blow out to 30 years, but that's probably the rarity. It's not the norm that we're seeing commercial loans over a 30-year loan term. It's generally that 15 or 20-year term. So hopefully that covers out some details about loans. In terms of types of lenders, as I said, we've got 34 lenders on our panel. So you've got the big four. So the big four, obviously CBA, NAB, Westpac, and ANZ. Slow, dinosaurs, very hard to deal with, take a long time to get things done, and generally don't offer you the best deals in the market as well. So hence why they have some refinance rebate offers out there. The majors will give you a refinance rebate if you refinance your home loan to them. I think that's pretty much, I guess, payback for the fact their rates are a bit higher and they're a bit slower to move than some of the other lenders. The second tier banks that I generally deal with are lenders like Macquarie Bank, ING, HSBC, a lender called Kudos, which is the old Qantas Credit Union. So there's a large number of second tier lenders, and they are better to deal with from a home loan point of view. They are quicker to the mark. They are generally better with their credit assessment criteria. Their interest rates are generally finer and price pointed much better for the clients as well. So from my point of view, I try and steer clear of the big four when I can, just because the reasons I've outlined. And you get some terrific deals with the second tier lenders as well. And they're all known brands as well. It's not like a second tier lender is a lender who you've never heard of before. You know, the ones I've known before, the Macquarie, the INGs, they're all major international organisations. So they're very good banks. Sorry?
Bendigo Bank?
Don't talk about Bendigo Bank because they're not on our panel. There is some talk that they may join our panel at some stage, but they don't have much of a broker representation, to be honest. They're a community bank, so they try and source everything through their banks. Give you an idea, we're closing on 60% of all home loans are written through the third-party channel or the broker-originated channel. So hence you see a lot of the media at the moment around banks closing their branches, particularly those big four. because they don't have people going in to see them anymore to get home loans. They're all dealt with through our channel. And principally, why would you go and see a bank and talk about their interest rate and their only product when you can go to a mortgage broker and talk about 34 different banks and what their products and processes and interest rates are like? So, yeah, so there's some opportunities and a big widespread of banks there. Lenders who offer credit impaired clients, yeah, clients who have had bad debts, they have bad repayment history, they've defaulted on loans, they've defaulted on mobile phone bills, they've had arrears on loans, have tax debt that they haven't paid off. So a number of those things, the major lenders and the traditional lenders won't look at. But there are lenders specifically who offer services to clients that have those credit impaired issues. Generally, they've either got to be cleaned up as part of the application, or there's a history of them having been paid off a little while ago, but still appearing on people's credit reports. So there's probably about 3 or 4 lenders around that who will look at credit impaired. You may have heard of Pepper Money, big sponsor of St Kilda Football Club, Liberty Financial. Those sort of lenders are lenders who are really in that credit impaired space. From a commercial lender point of view, yeah, you have the majors, plus a few other sort of, I guess, second tier lenders who deal in the commercial lending space. Your loan to valuation ratios are a bit tighter. Generally, you're sort of looking at 70% commercial property loan to valuation ratio. So you've got to put in a bit more equity when you're looking at commercial. They'll look at security of tenancies, who the tenants are, what the lease profile is. So if there's multiple tenants, like a shopping centre, for example, they'll look at who the underpinning tenant is, who the major tenant is, and who the other tenants are. They'll get an average of your tenancy profiles to work out exactly what the lifespan of your loan should be. And interest rates are still pretty good. They're not that far away from the home loan market at the moment, surprisingly enough. So you're certainly in the 2s and 3s on the commercial space, which is excellent. So self-managed super funds. So about 3 or 4 years ago, just about every bank was lending to self-managed super funds to buy property, and they can buy residential and commercial property. Most of those banks jumped out of that self-managed super fund market about 2 or 3 years ago, probably sort of 2.5 years ago. To the extent now there's only sort of 2 or 3, probably maximum 4 lenders who are actually delving into that self-managed super fund space. Really restrictive into what you can do. You can only buy to, so you can only borrow to buy property. You can't develop, renovate, cash out against equity or anything like that. Once you buy a property, it just sits in your super fund. You can't touch it until the loan's paid out, and you either transfer it out of your fund or it stays in there forever. There's certainly tax advantages to doing that. I'm not a tax expert, so I can't give you tax advice, but there are lenders out there and there are people out there who are borrowing to buy investment properties in their self-managed super fund. It's an expensive form of finance. Traditional home loan, you might get 2.6, 2.7. A self-managed super fund, you're probably getting 5.5 to 6% interest rates. And it's reasonably costly to set up as well. You've got to engage accountants to set up trustees and super funds and all that type of stuff. But certainly there is a market for self-managed super fund borrowings. And small business cash flow lenders, yeah, look, there's a few of them around. You've probably heard of mobs like Prosper and On Deck and those sort of lenders. They traditionally don't focus on what the security is of the client. They're more focused on the cash flow. So how the business has been trading over the last couple of years, how long the business has been around for. They're looking for well-established businesses who maybe don't have property that they can use as security, who they can then take a punt on the fact that they're going to be around in the future. They're more expensive. They have shorter loan terms. The repayments are generally significantly higher than what a normal cash flow lend would be when it's asset backed with a major. So there is some you've got to be really consistent and understand that your cash flow is really strong to be looking at those sort of lenders. Those lenders will be really focused on the historical performance of the business plus the projections of the business. So part of the work you'd need to do when you're looking at talking to those lenders. And to some extent on the commercial lending front, if it's not just pure property investment, but it's also borrowing for the ongoing performance of the business. Got to put a lot of time and effort into not only providing financial statements, but providing cash flow projections, making sure you understand completely what underpins those projections, so that when the bank comes back and starts asking questions about how you've come up with these assumptions for how the business is going to track going forward. They're pretty easy to explain. So, but yeah, small business lenders, they're around. They serve a really strong purpose in the market, but they're not for everyone. Alrighty, government grants. A really interesting topic, government grants at the moment. There's a number of them around there. First homeowners grant, so that's applicable for anyone who's a first home buyer who's building a property. So it's only applicable to building. It's not applicable if you're buying a property unless the property is 2 years old and has never been lived in before. And we might be able to get you into that pace, but generally people who are looking to build, it's there to stimulate the building economy. That's $10,000 if you're buying and building in Metro Melbourne, jumps up to 20 if you're in regional locations. It's generally paid across by the government with your first progress payment to the builder. So generally when your foundations or your slabs laid, the government generally pays that money across. You don't actually see it come into your pocket. So it's just I guess it's just a payment across to the builder that comes off your contract price. So qualifying criteria, the maximum house and land package is $750,000. You've got to be a first home buyer. Neither applicant or their spouse can have owned a property that they've lived in before. A lot of people think, I haven't owned a property before, but my partner has, therefore I can apply for it in my own name. No, you're doing a declaration to say that neither you or your spouse have owned property before. So it's a bit of a trap where people think they can qualify and they can't. Stamp duty concessions for first home buyers. So when you're buying an established property or even buying house and land and stamp duty on the land, if the purchase price is less than $600,000, then there's no stamp duty applicable for first home buyers. That's a significant savings. Stamp duty can sometimes run up to 5% of the purchase price. So saving that for first home buyers is fantastic. Great opportunity to get into the market. So a lot of your deposit isn't being eaten up in costs. It's actually going towards what it's supposed to be going towards, which is a deposit on the property. Home building grant is a fairly new one that's been released by the federal government since COVID. So what they're offering is $25,000 grant for new home building or renovations where the minimum renovation cost is $150,000. So it's a sizable renovation you've got to undertake to qualify for the grant. Single applicants, maximum income $125,000, joint applicants maximum income $200,000. So some qualifying criteria. There's criteria around how much your property can be worth at the end of the day. It's really an interesting one, this home builder grant at the moment, because unlike the first homeowners grant where the banks control that process and they can actually control the release of the funds, the home building grant isn't the case. That's actually money that's just paid to the applicants. So because the bank doesn't control that process, they don't class that at this present point in time as part of your deposit. So you've actually got to almost exclude that from your calculations when you're talking to lenders to how much deposit you've got. We are, as an industry, trying to get that changed around and trying to get that overturned so that it can be paid the same as the first homeowners grant, and we can take it into account. But a lot of people at the moment who, particularly first home buyers who think, I could get $10,000 first homeowners grant, $25,000 home building grant, I can probably get away with getting into a house and land package with $10,000, $15,000 of my own money. You can't because of how the banks are assessing and how the government's paying this home builders grant. So we're having a lot of people inquire about it and we're getting caught out because that's not being paid to them at the moment. I believe that's in the process of potentially changing, but it's going to take a little while for that to happen. I think it took 2 or 3 months after the federal government announced the initiative for the state revenue officers in each of the states to work out how they're actually going to take applications. So it's a work in progress, that one. And there is just quickly before I go on to the next slide, there is a first home loan deposit scheme that I did mention just briefly before, where the federal government will consider paying up to your mortgage insurance cost if you're borrowing more than 80% of the property value if you are a first home buyer. Again, that can be a considerable savings. The issue is there's only 10,000 grants released every financial year. I can tell you that the grants were released on the 1st of July this year have all gone already. And they get snapped up really quickly. There is qualifying criteria as well. You've really got to get in really quickly if you want to get access to that. I'm not sure how long that scheme will be around for. I guess it's probably got a little bit while to go, but all the grants for this year are taken up. They're due to release some more in July next year. But yeah, 10,000 across Australia doesn't go very far when people are trying to get access to these grants. So that's one I haven't put in there just because the availability is pretty limited, but it is something that we do talk about as well. Alrighty, now Damien, you can go on the next one.
I'm gonna try now. Won't do it. Here we go.
Cool. Alrighty. So current lending environment, are lenders still lending? Yeah, they are. Definitely lenders are still lending. Their doors are open. They've got to keep money going out the door. Having said that, the credit criteria, how they're assessing deals has probably got a little bit more stringent than what they had been in the past. Some lenders have been deemed to be more open for business than others. And as I said at the very start, it's a case of understanding what your needs are, what your requirements are, and matching you with a lender that's going to fit in well with you. So, but yeah, lenders are still open. They're still lending. I think the thing that's holding the economy back or the property market back at the moment is access to people being able to inspect properties. Majority of my loans at the moment, I'm writing for refinancing opportunities where people have said, well, gee, haven't had a look at our loans for a long time. Why don't we look at that and see if we can get ourselves a better deal? We believe the market will probably kick in when we can get out of lockdown. There's a lot of people wanting to put their properties on the market for sale, but just have been holding off. So we think there's going to be a bit of a kick along in that space, hopefully when we come towards lockdown. But a simple answer, are lenders still lending? Yeah, they are. Interest rates, I think I talked about interest rates before, but where are they now? So a good variable interest rate will be somewhere between 2.5 and 2.8, depending on the lender and how much equity you've got in your transaction. Fixed rates, 2-year fixed rates as low as 2.09 for owner-occupied properties I'm seeing at the moment, which is just phenomenal. Anywhere sort of that 2.09 to 2.3 thereabouts on the owner-occupied loans. Even investment loans at the moment are attracting rates around the 2.6, 2.7 mark. So fantastically low rates, some awesome opportunities for people who do want to borrow money. Will they go up and down? Well, the speculation is that they're probably not going to move for the next couple of years. And I think that's probably borne out in where some of the fixed rates are at the moment, that we don't think there'll be a lot of movement in interest rates. So current lending environment, challenging, but yeah, deals are still being done and lenders still need to get money out the door, so they are lending. Righty, so how can we help you? So I think, as I've touched on, large number of lenders, 34 on the residential front, there's probably a dozen or so on the commercial front. Why go into a bank and talk to them about their own product when they can only offer you the one range of products and their one policy, when you can talk to a mortgage broker that can talk to you about what 34 different lenders can do, can find you the best deal across the market so you don't have to shop around. We do everything from start to finish. From the time we understand your needs and gather all the information, write the application, we negotiate the approval, we submit your loan, help you sign your loan documents, assist your conveyancer with getting ready for settlement. So pretty much from start to finish is our involvement. And with us, with Smartline, we actually review your loan every 12 months as well to make sure it's still working for you, or whether there's other deals out in the market we should be looking at. Ideally, we should be reviewing your loan, a proper full-on review every couple of years. You don't pay a mortgage broker for their services. It all comes at no cost. We're paid by the banks. We receive, and it's all fully disclosed in our documentation. There has to be as part of our legislation, but we receive an upfront payment and then we receive a trail based on your loan balance for the life that your loan continues on. Again, as I said, all fully disclosed, but no cost to you. The bank doesn't add any margins onto your interest rates or your fees or anything like that to cover our costs. They understand that they have to embrace us as a source of business for them, given we're a large writer of home loan business. Same thing works for commercial. We identify the needs, we find the solutions and work out which lenders are going to be the right lenders for you. Do all the same things that we would for a home loan. I think the critical thing to take out from that point of view is just preparation is really important in terms of getting ready to borrow money, getting your information together, clearing up any things that might be outstanding from your past, and just really making sure that you're presenting a cleaner slate as possible you can when the time comes. In terms of existing loans, I said a couple of minutes ago that most of my business is coming from refinancing clients at the moment. given things change, banks tend to let interest rates slip, and before you know it, your rates will creep up on you without having a look at it. Banks are quite weird creatures in that they don't tend to look after their existing clients as well as they should, and they tend to throw better deals at new clients. Common sense to me would suggest you look after your existing clients really well, but banks don't tend to do that for some reason. They're all out there trying to grab new clients. So look at new opportunities. If you haven't reviewed your loans for the last couple of years, now is the perfect time to review it. Interest rates are at all-time lows. There's some fantastic deals out there. I mentioned before, there's some lenders offering refinance rebates, so they might pay you a few $1,000s to refinance your loans across to them. And there's money that can be saved. To share a success story, I refinanced a client that settled a couple of weeks ago, to be honest, and refinanced their home loan and their investment loan. By the time we did all that, took them across to a new bank. It cost them about, $1,200 in cost to refinance. They received a refinance rebate of $4,000 from the bank, so covered their costs and put money back in their pocket. And they're actually $8,000 a year better off in interest costs. So, why that happened? Because they suddenly decided that, we hadn't looked at our loan for a few years. Maybe we should see if our bank's still looking after us. They wouldn't match what other banks were doing. They went back and asked them to match, and they couldn't match what I had suggested that they should be doing. And suddenly they've got all this money in their pocket, which they can, do whatever they want with. They can put it in as extra repayments on their home loan, which is going to shorten their loan term. They can just pocket the money and spend it on whatever they want to spend it on. So, if you're not looking at your loan every 2 years, you're probably not doing yourself you're not doing yourself justice in terms of the opportunities that are there for you in the market. Damien, do you want to sort of reflect on your own personal circumstances with that?
Yeah, well, thanks, Gary. I mean, I was a loyal CBA customer for 25 years, and I saw them advertising lower rates to new customers. I asked for that rate to be applied to my loan, and I was told they couldn't do it because I'm not a new customer. So that's when I went down the path of reviewing my loan. I should have done it a lot earlier. It's probably one of the lessons you can pass on to your students as well in the classroom, that loans are like motor cars or whatever. They need to be serviced and reviewed every so often. After having reviewed my loan, it went from the CBA to the Bankwest. Bankwest is owned by Commonwealth Bank. The Bankwest offered a 0.85% lower rate on my loan. So so that's just a lesson learned about, an important life lesson, I would say, about what you need to do with your loans.
Done by me too, mate, you should point out.
That was done by it was.
And that was
I hate filling out forms and it was made easy. So rather than me having to fill out a form for each bank to have for me to approach, Gary did it all in the one go.
Yep.
So just on that, Gary, I'll just I know we're getting close to your end of the presentation. Are we?
Yep. I think we've got one to go, haven't we?
Doesn't seem to want to move too easily. There we go. So
I think
takeaways.
How about I summarise that, and then we'll see if we've got any questions and we can have a chat. So, review your loan every 2 years. If you come with me, I'll review them every year anyway. But realistically, every 2 years is a really key time to do a proper full-on review. Banks are offering better deals to new clients. If you're looking to purchase a new home, consolidate your loans, take out finance for any reason, start preparation early. A really strong message to pass on to students. If you're looking to borrow money for whatever reason, start early, start in advance of when you need it, even if it's a car loan or anything like that. Start having the thoughts around, what do I need to do now to borrow in 3 or 6 months' time? Do I need to change my spending habits? Do I need to pull back on some of my discretionary spending? Do I need to clear up some zip pay accounts I may have? Have I got an old store card from when I bought some furniture from Harvey Norman a couple of years ago that I haven't cancelled that I need to know about? 3 to 6 months out to when you need to start thinking about it. No point lodging an application, the bank coming back and saying you're spending too much money on all these things, and you've got nowhere to go because you haven't started the preparation early enough. So 6 months out, 3 months is an absolute minimum is where you need to start having that preparation, making sure you're gathering your information, bank statements, pay slips, all that type of thing. And if you're looking for commercial finance, I think this applies to commercial finance or residential finance nowadays. You need someone to do the work for you. It's just too hard to know what each of the lenders are offering and what they're looking for. So you need to really engage a professional to help you out with your finance. I think the days of being able to go into the bank and doing it yourself are sort of a bit of a long gone option. So why not get someone who can do it for you at no cost to you and can get you the best deal at the same time? You wouldn't buy a car going to one car dealership, you'd shop it around, so your loan should be no different.
And if they come to you, Gary, they'll get a house like the one on the screen.
It looks like yours.
Yeah, good on you.
So
Okay.
look, part of my presentation is finished. I'm happy to answer any questions whatsoever. Or if people want to talk to me about their own individual circumstances, I think our contact details are on the slides as well. So feel free to reach out, phone calls, emails. I'm really casual around how we have a chat about your own circumstances, or if you've got any questions where you want me to sort of flesh out a bit more around some of the things we've talked about for your students or whatever, just reach out. Yeah, I'm a phone call or an email away.
Well, and just on that, Gary, one of the questions that is about the webinar. You know, the focus was on teaching their students the traps and pitfalls and life lessons about loans. And I think we've done that, but I mean, in terms of you've outlined, you know, what a student needs to do. Well, once they get into post studies and start to earn an income and want to buy a house, what they need to do to take out a loan, what to watch out for. You talked about the preparation, you talked about spending habits, you talked about all the different types of lenders, talked about you know, the option of using a mortgage broker, the grants that are available, what the bank looks for. So I think, in my mind, you have, but you know, we will stand corrected, and I'm sure you would be happy to, after the webinar, you know, if anyone wants to get in touch with you, that you will more than happily, you know, sort of probably focus it more on what they want to be able to take out of the webinar and
yeah,
to their students.
Most definitely, yeah, for sure. I'm more than happy to have those conversations. I think the important thing to impress on students though is the preparation and the early review of where you want to be. And I think a lot of people tend to think that I didn't pay my phone card debt, or I didn't pay my phone bill and went into arrears and just thought they'll never catch up with me. I think that's an important lesson that people need to know, that will catch up with you at some stage when you want to borrow money. So don't think you can walk away from commitments with banks and finance companies and for not have ramifications on you at some stage in the future as well. So I know quite a few people, I went through a period of time not long ago where quite a few people I was talking to looking at first home buyers and had these debts with you know, phone companies, and just walked away from them thinking they'll never catch us. And it did come up and catch them and bit them pretty hard on the backside when it stopped them from getting their loans to buy their houses. So it's just understanding that you've got to meet your commitments, you've got to meet your obligations, you've got to pay all your bills on time, even things like utility bills and phone bills and that. Now we're in the day of open banking, the banks will find out if you're late on them, and it will have an adverse I guess, reaction to your likelihood of success in getting finance. So, but yeah, more than happy if anyone wants to reach out to me separately. You know, we can't cover all topics in the time that we've got, but more than happy to have more detailed conversations for anyone that wants to have them.
Thank you. I'm looking forward to the answer to the next question, Gary.
This is where I log out.
Are all mortgage brokers honest, and can they be swayed by certain products?
Well, I think no. I'll put my hand on my heart and say all mortgage brokers aren't honest. Is there any industry where everyone's all completely honest and above board? What I can say is, if you look at the complaints that are lodged against mortgage brokers in the finance industry, I think it's, don't quote me on the stats, but I think it's 0.5% of all complaints lodged to the financial ombudsman relate to mortgage brokers. So 0.5% of all complaints, or something around that mark. So by and large, the majority of us are. I said to you at the start, I get my business from word of mouth by doing a good job for you. So if I'm not looking after you and acting in your best interest, you're not going to refer me to people that you know. I'm not going to grow my business, and my business is going to stagnate and get a bad reputation. So there is no reason for me, and I would assume my colleagues, to give anyone bad service, bad advice or anything like that, because it's just not going to help us grow our business. At the end of the day, we're small business people like a lot of other small businesses who are relying on being able to provide a product and a service.
And another good question is about if you have a preference to borrow from a bank that doesn't lend to fossil fuel companies, etc. Will that reduce your ability to get a good rate?
Yes, it will, quite simply. There are, as I said, 34 lenders on the panel. I think there's 3 of them who don't engage in those processes and are eco-friendly. So if you're wanting a bank who's going to, or a lender who's going to operate along those lines, then your choice is reduced significantly from 34 down to 3 lenders who might operate in that space. So it just limits your options, I guess, more than anything. It may not stop you from getting the best deal, but it limits the number of lenders we can look at for you.
So they have a choice. I mean, they don't have to go with the bank or the lender that you suggest. I mean, it's...
No, not at all. I mean, it's a conversation. It's just like I say, look, I think these 3 or 4 lenders are probably the best fit for you. This is what they offer. Actually give you a written recommendation with generally the 4 lenders who I think are going to be the best fit for you. And then it's a conversation and agreement to say this is a lender that you decide you want to go with and for these reasons. So I'll give you recommendations, I'll give you suggestions, but ultimately, if you have a preferred lender you want to deal with, then I have no issue with that whatsoever. You've got to go with whoever makes you happy. And
just quickly, someone's asked, Ubank, are they, where do they fit into that lending you talked about?
Yeah, Ubank's an online lender. There are a few online lenders around at the moment. We don't deal with online lenders. Quite simply, my experiences with Ubank are in refinancing clients away from them as opposed to them doing the loan. You just got to be careful with the online lenders. If something goes wrong or the process isn't what you're expecting it to be, you've got nowhere to go. You've got no one to talk to. We don't have online lenders on our panel. We've got lenders who have an online presence. They've got their own websites, their own internet banking, their own apps and what have you. But we don't have any lenders who are purely online lenders on our panel just because we don't think they offer the right service proposition for our clients.
Okay, and final question, and it might be a good question for to be able to help students as well, is credit ranking or credit score. How do you access or how do you find out what you talk about an open banking system now? How you can get your credit ranking?
Yeah, look, there's a number of number of credit agencies will let you get your own credit score. You are entitled to 1 free credit check per annum on yourself anyway. There's a credit reference agency called Equifax. It's EQUIFAX. I think they will give you 1 free credit report per annum on yourself. It's really easy. It's an online platform. You put in your personal details, your driver's license, and you can get a full credit report on yourself, which details credit history, repayment history, any commitments you still got outstanding. So if there's that long forgotten credit card that we talked about, it'll show up on there. They're not the easiest things to read sometimes, but they are there and they are accessible to you. And there's a number of other organisations that you see advertised on TV, Credit Savvy, Get Credit Score, number of online platforms where you can get a credit report on yourself.
All right. Well, I think that we've answered all the questions that have come up. I'll give everybody a minute or two if they want to put another question in on the board. But I think you've covered off everything that we hoped you would have covered off on. And I see we're getting close to the 55-minute mark, so we're running to schedule.
I was just going to just reiterate, if anyone wants to reach out personally, I think you've got my details there and your details there. So a phone call or an email or whatever works for everyone. More than happy to answer anyone's questions about their own situation, or if they want me to flesh out a bit more about some more information for students. More than happy to have that conversation with anyone who wants to talk to me.
Thank you. I'll just make sure we haven't